tightening financial conditions. It is also decoupled from inflation expectations. So it's not about inflation. So what is going on is every 4 years, all of the major governments around the world have to roll the debt. Now, it's this 4-year cycle, something I call the everything code cycle, because in 2008, there was a debt jubilee of where they reset interest rates to zero.
There was some instability in the cryptocurrency market to start the week, with Bitcoin, the largest cryptocurrency by market capitalization, plunging to a monthly low of $9,800 on Monday. The turmoil swiftly extended to other cryptocurrencies. While many investors were panicking and forecasting that the cycle peak had already occurred in December and that there would be no more price increases in 2025, Real Vision founder and CEO Raoul Pal claimed it was the dollar wrecking ball at work. Pal has often talked about the significant impact of a strong US dollar on the global economy and financial markets, including cryptocurrencies. Ethereum fell below $3,000 for the first time since early November, and other major altcoins fell to multi-week lows. He calls the occurrence the dollar wrecking ball, highlighting the significant difficulties that might arise from a dollar that appreciates quickly. Globally, according to Pal, governments and companies with dollar-denominated debt find it more difficult to meet their obligations when the dollar appreciates significantly. This higher cost might result in less liquidity and financial strain on international markets. Pal thinks that President-elect Donald Trump is currently using this wrecking ball to persuade nations like China, Canada, and others to accept his policies upon his inauguration, but that this negotiating tool will only be employed temporarily because of the significant effects on the financial markets and global economy. Pal contends that a number of Trump's suggested initiatives, like enacting tariffs and pursuing fiscal expansion, will devalue the dollar and significantly boost the markets. In a recent interview with Jimmy Connor, the CEO of Real Vision makes the case for the effects of a strong sol on the U.S. economy and the markets, emphasizing how interest rates and inflation could continue to change in 2025. As we bring you snippets from Pal's masterclass on the U.S. and global economies in 2025 and beyond, please take a moment to like this video, subscribe to the channel, and enable post notifications for more videos like this. Your actions greatly aid the YouTube algorithm and the channel's expansion. Thank you and enjoy the video.
But if I look further ahead, I think this is maybe the most deflationary period anybody's ever lived through because of robotics and AI. We're creating infinite people, or people in inverted commas, at zero cost. I mean, Amazon now employs more robots than people. So they're the largest employer in the United States, I think, outside of the Postal Service, or maybe the largest employer. But they have more robots now, and the robots work 24/7, 7 days a week, never complain, never take a tea break. Exactly, they never complain, don't have any HR issues, nothing. And so look, if you step back, it means that everybody is economically incentivized to use technology as opposed to people. That's a fact. Go to a Tesla factory, it's all robots. Go to any modern factory. So even if the re-onshoring of manufacturing in the US, a big Trump thing, they're not going to employ people. It's not the 1950s anymore. This is a very, very different world where nobody employs people if they can avoid it, because technology is so much cheaper and more effective. I am, because it's tightening financial conditions. It is also decoupled from inflation expectations. So it's not about inflation. So what is going on is every 4 years, all of the major governments around the world have to roll the debt. Now, it's this 4-year cycle, something I call the everything code cycle, because in 2008, there was a debt jubilee of where they reset interest rates to zero. All of the governments, therefore, didn't have to pay interest for a while. So it was a break on interest. So it was like a debt jubilee. It's like, don't worry about it, guys. Don't pay your interest. Sort out your debts. They all restructured their debts into the 3 to 5 year sector. And so 4 years being in the middle of it. And it's created this perfect cycle that's been happening since 2008. What has happened this time around, because we had the pandemic inflation, it's been very late for them to cut rates. Normally, in this point in the cycle, they would have cut rates back down to trend rate of GDP growth, let's say 2%, but they couldn't. So what's happening is the debt is now compounding into new debt because they're issuing new debt to pay old debts. And so what you've got is a tsunami of debt that's happening, which is why they need to get interest rates down. So it's that dynamic that's causing it, is the issuance. Something will give at some point. Either the governments are going to have to stop it because everyone's got the same problem, and the UK interest rates just hit what it was like a 30, 40-year high. It's unsustainable in highly indebted economies. So they're all going to have to do something. Now, whether it's a yield curve control idea, which is they kind of, as opposed to forgiving all the debt payments, they say, we're going to cap interest rate on government debt at X%. Or you have to do QE, but certainly what they're desperate for is to add liquidity into the system. There's a tightness of liquidity that stops people buying the bonds, which is why the excess issuance isn't being bought. The other issue is the dollar's too strong. So it's expensive for the Japanese and the Chinese and the Europeans to buy US government bonds. So again, it's another reason they've got to get the dollar lower, got to get the rates lower. And then I think it will free up the 10-year. Trump has already said interest rates are too high. And I think Scott Bessent's first job is to figure out this particular mess. I am, because it's tightening financial conditions. It is also decoupled from inflation expectations. So it's not about inflation. No difference to Google, Apple, Meta, OpenAI, none of these guys, because those guys compound growth at 30% a year. So a 5% hurdle rate. Don't forget, they all sit on cash. So they actually make more money as interest rates go up, which people don't realize. So I'm not worried about that. If inflation came back, then you have to discount the cash flows. But with rates up, it's not an issue. It is for the regular economy, which creates this bifurcation. And I think that, look, there is a risk that it goes to 5% and 5.5%. So I think there is going to be some pressure from Trump to organize this as fast as possible. The other side of the equation that makes some complexity to it is Trump wants to renegotiate trade terms with everybody, whether it's Canada, whether it's China, whether it's Europe. And the best way to beat everybody into submission is a strong dollar. And so, because they all have dollar debts as well. So what he's going to do is use the strong dollar as the stick and then offer the carrot. And the carrot will be, we will lower the dollar if you agree tariffs or changes in the trade deficits. Well, really, if the US just says it wants a lower dollar, it actually tends to work. The other way is giving access to swap lines to China, Japan, and others who have large dollar borrowings. So that's an injection of liquidity directly into those countries. And then they can recycle that into buying treasuries. That's usually how it works. So there's some way of the US, via the Federal Reserve, lending money into the global system to alleviate the dollar shortage that those people have. They recycle that because they have the dollars, they buy treasuries, and everybody's a winner. So that is the mechanism. So then you ask, well, why are they not doing that? Why is the dollar so strong? It's because they want it strong. And the reason they want it strong is to quickly get an agreement on trade deals. Well, when you listen to Scott Bessent, you listen to a few of the others, one of the other things, why are they talking, what is this nonsense with Canada? What's that all about? It's all about oil. Trump knows, as does Scott Bessent, is we need lower oil price. Even though it's not particularly expensive right now, but a low oil price gets the economic machine working. And they want the Canadians to pump as much oil as possible, the Keystone Pipeline, all of those things. So look, there's lots of moving parts. Some are inflationary, some take time, and others are simple fix. A simple fix is you can add liquidity via either the Federal Reserve or via the Treasury, and you can stimulate assets. So they've got that under their control. So then somehow you need the economy to grow enough via deregulation but you don't want it inflationary, so you're trying to keep a cap on commodity prices. There's a lot of moving parts here. So look, it's not an easy thing, and we will definitely, as the economic cycle picks up, we will definitely see inflation come back. But the question we ask ourselves is it coming back in a non-cyclical structural fashion, where you see that chart that goes around Twitter all day about the 1970s all over again? Is it that, or is it just a normal business cycle where inflation picks up and then it goes down again?
Meanwhile, the price of cryptocurrencies has quickly rebounded from Sunday's bloodbath. Earlier today, the total market capitalization of cryptocurrencies reached $3.5 trillion, increasing by $152 billion in a single day. According to data from CoinMarketCap, Bitcoin briefly recovered $100,000 to reach an intraday high of $1,650. Although prices have slightly retraced, Bitcoin is still up more than 5% in the last 7 days and roughly 3% in the last 24 hours. However, XRP is the true outperformer among the top 10 cryptocurrencies, surpassing $3 for the first time since 2018 and currently trading at $33.32, up 16% in the last day and more than 35% in the last week. With a market cap of $19.9177 billion, XRP is currently trading at $33.32. XRP has maintained its ranking as the third largest digital asset in terms of market capitalization. Additional gains will put XRP on pace to reach or possibly surpass the all-time high of $3.84 in 2018 at $210 per coin. Additionally, Solana may be on course to reach and surpass its current all-time high of $264. Investors are attributing the Layer 1 token's more than 11% growth in the last day and roughly 8% increase in the last week to following a recent insider claim that the SEC may relax crypto enforcement under the Donald Trump administration. The market recovered. According to the article, which was first released by Reuters, the regulatory body is prepared for a strategic change in how it regulates cryptocurrencies under Trump. Republican Commissioners Hester Pierce and Mark Yuita are anticipated to lead initiatives to define when cryptocurrencies constitute securities, according to Reuters, while reassessing some of the vigorous enforcement actions carried out under departing SEC Chair Gary Gensler. This program seeks to give long-awaited regulatory advice. Known for their pro-innovation views and ties to SEC Chair nominee Paul Atkins, Pierce and UEDA are getting ready to begin these initiatives on January 20, just after Trump's inauguration. During Gensler's term, the SEC pursued 83 enforcement actions pertaining to cryptocurrencies, frequently claiming that numerous tokens constituted securities under the agency's purview. Atkins, who is well known as a proponent of cryptocurrency innovation, is anticipated to adopt a more lenient regulatory and enforcement approach than Gensler, but his Senate confirmation is still pending. The SEC may take a more industry-friendly stance under the incoming administration, emphasizing cooperation and more transparent rules rather than punitive actions. Insiders tell Reuters that during the first few weeks of the administration, the SEC may decide to delay or even drop certain current lawsuits in cases unrelated to fraud involving cryptocurrencies. As the new administration gets ready to change the regulatory environment for digital assets, industry stakeholders are closely monitoring the changes, which could mark a turning point for cryptocurrency regulation in the U.S. by lowering uncertainty and lessening the compliance burden on the sector. The Commission is also expected to solicit public input in order to help establish clear and precise regulatory frameworks for the emerging crypto industry. Please let us know what you think of Raoul Pal's interview and the current cryptocurrency market rally. If you liked this video and would like to see more, please hit the like button. This will help the channel expand and connect with more incredible people just like you. Also, don't forget to subscribe and enable the notification bell so you never miss an update. We are incredibly grateful for your support, which inspires us to provide you with more fascinating information. Together, let's expand our community. Thank you for sharing in my adventure.